Growth stocks are necessary if you are thinking recession investment strategy. Zoom Communications, Tesla, and Amazon hit their all-time highs during a global pandemic that shut down global economies. However, that comes second to government bonds shielded from interest rate movements. Today's video will share the best investment strategies during a recession. Let us begin. Number 5. Preferred shares. The choice to invest in a recession is a scary subject on its own. However, if you have to do it, take your money where everyone else is going. In investment, intentional priority is offered to those who buy preferred shares. If you have not made the connection already, preferred shares are the most secure stock to own when doom is looming. Due to the scare of a recession, all investors will rank preferred shares as the best choice for economic disaster. In a company, common share dividends are served after preferred dividends. Moreover, should a company break up, the preferred shares receive priority treatment before the other shares. To illustrate, preferred stocks are the least likely to be canceled, their dividends are never cut, and they have the slowest decline rates. Preferred bonds are mostly cushioned from bank interest rates falling.
That will do.
Another safety investment strategy happens to be the growth stocks. Profits and dividends in those areas have not declined despite a 70% average low on the stock exchange. Shortly, we will understand why the growth stocks are necessary. Number 4. Bonds. Up the ladder of safety are investments in bonds. As financial advisor and author Suze Orman once said, every portfolio benefits from bonds. They provide a cushion when the stock market hits a rough patch. They are typically safer than preferred shares. In fact, they are safer than all shares and dividend. When the central bank decides to fix a recession, it might use various means to get the economy to respond. For instance, the Fed's high interest rates will slowly start fading. As they decline, no interest rate movements will affect long-term bonds. They outperform stocks and are a safer bet to shield your money from economic turmoil. In addition, government bonds have a better guarantee since they are controlled by the same people controlling fiat money and the economy. When you buy a state, metropolitan, or federal bond, your safety net is locked for as long as you decide. Therefore, it is higher than private bonds and preferred stocks. Number 3. Growth stock. Growth stocks have not received the best PR since the year started. Some of the most notable ones, including Tesla, Amazon, and Alphabet, have faced a harsh decline. Many growth stocks have seen over 70% decline.
And it was a big blow.
However, the Forbes list of wealthiest men in the world are all owners of companies that are categorized as a growth stock. That is because most growth stocks have a high margin in their markets, making their sales consistent despite the recession. For example, Tesla has kept recording quarterly sales for the last 5 years. Therefore, even if there is a recession, it might not entirely affect the profit bearings of the company. Additionally, one must find new growth stocks that are fixed, like cybersecurity, AI, and online entertainment. If the pandemic taught us anything, those industries see a rise when the rest of the world is down and the economy shits down. As you consider tech stocks, think of other sectors with a growth history despite the economic decline. For instance, the utilities, health, and consumer goods. Later, we will tell you what sectors are the best strategy for the recession. Number 2. Dollar cost average. When the economy is under siege, you must invest with a strategy beyond what stocks to buy. For instance, what if you purchased preferred shares with all your money, but the company crashes altogether? That is why the dollar cost average strategy is a tested option to ensure that you know exactly what you are getting into. The economy does not sink entirely into a recession, and there are better months than others in the sometimes over 30-month period. Therefore, start by splitting your investment over time. For instance, you can invest $200 over 20 months to make up for your $4,000 investment plan. That way, you can watch as the market reacts to your inputs. Further, many companies do not take commission fees for your transactions so that you can play out the process, and your average price will have some good highs by the end of the period. Have you searched for excellent investment tips and updates on significant investment profiles? We have it all here on this channel. Just subscribe not to miss anything we post. Number 1. Buy profitable sectors. Let us get a proper hang of things. It would be best if you bought the sectors that hold up best during tough times. One must be specific when going into the industry. If you invest in consumer staples, there is no way people will stop eating. The communication sector, like phones, video call services, and social media, might never go out. People will not cut off their heaters or electricity if you invest in utilities. If you have a headache that needs drugs, the recession cannot stop you from getting them.
Oh, that's super.
Research into diseases will continue to raise money despite the state of the economy. In fact, as of June, the stock exchange projected an average annual 4.3% fall on all health stocks. This is better than what the major growth stock is experiencing per month. Thus, buying healthcare is essential for your portfolio as we enter the recession. Well, if you have all these investments and other assets, how do you avoid losing them during a recession? We have the answers in a previous video on how to protect your assets during the 2022 recession.